Yesterday may have been one of the worst earning days we have seen in a long time. Walgreens reported in the morning and they were down over 20%. Nike reported after hours and they are down massively and are the focus of today's episode. As we can see, the market has just opened and they are down around 17%. Year to date, a massive 28%. Today we are going to focus on this company. We're going to understand what has gone wrong for this company with their earnings. Is it an undervalued buy? Can we see a lot of upside? And what are we specifically doing with this company? We'll also take a look understanding their market share. Where do they sit in terms of lots of different factors? We'll also look at their numbers, their revenue growth, their bottom line net income. Where has this company been historically? What are we anticipating over the future? As well as looking at the health of this company, which is important. They do have a pretty strong balance sheet, which does help them when we do come to analyze this as part of our own portfolio. And as always, we'll look at their dividend safety, which does look very strong with a 99 safe score. And we'll run through the underlying supporting metrics, not just the free cash flows, the ROICs, their debt levels, and the other usual topic. We'll also take a look at what the insiders are doing. As we can see, they are selling a lot of shares, just 20 million over the last few weeks. And we'll also look at the institutions to understand if there is a general theme with this company in times of those movements. Finally, as always, we are going to put it through the valuation model, getting to both our intrinsic value, our own acceptable buy price, and understand Wall Street themselves. Do they see a lot of upside over the next 12 months for this company? So the first thing to note, the headline does read that their shares did plunge after the retailer says their quarterly sales will fall 10%, which is massive, double digit, as well as talking about a lot of weakness that they see in China. On top of that, a few of the key points from this article, they have cut their full-year guidance, which is never a good sign. Remember what we've just talked about earlier with other episodes, what the market is looking for, not just a double beat, but also in fact to increase their forward guidance. So the fact that Nike, as we can see here, have had issues with their current earnings and have cut their full-year guidance, no surprises then why we are seeing that massive drop. But interestingly, they didn't miss on both. They did actually beat on the earnings per share. They missed on the sales, which we will come on to. And we can see the executives here do blame a lot of this down to the fact that there is a slowdown that they are seeing in the lifestyle sales. Now, what is quite interesting, because we are all consumers here, let me know in the comments below whether or not you do believe this is a company that is very strong, whether or not maybe the competitors have taken away some of their market share, depending on your own spending habits throughout the last few years. In terms of the numbers then, we can see 101 adjusted, so they did beat, as we mentioned. 83 cents was what the market had anticipated. In terms of the revenue, though, they did come under. You could argue marginal, 12.61 versus 12.84. But remember here, the main thing to understand is that they have cut their full year guidance. As we said, that will always kill a company very, very largely, as we have seen over 16% down, and we have just got the market open over the last 20 minutes. Now, this is never a good sign, as always, so it is understandable why the company has come down. The whole point here is to understand is if there is that market overreaction and if we can essentially take advantage. But what we can see, they do expect their full year 2025 sales to be down mid-single digits. Not a great sign. Analysts, although they had increased a very small increase of 0.9%, nonetheless, they had expected an increase. And what we can also see, they expect their sales in the first half of their financial year to be down high single digits. With their previous guidance, they were looking at declines in the low single digit. Not great at all. The finance chief does talk about how there is a comeback and it will take quite a lot of time for this to be seen throughout the numbers. Again, not something you want to be seeing if you are an investor over the longer term. And they do talk about how they are confident over the next few quarters that they will be able to reposition this, make it more competitive with a more balanced portfolio to essentially drive what all investors want to see: profitability, long-term growth, and see those come through the bottom line. So in terms of wrapping that up, they did beat on the earnings per share. They did miss, although marginally, on the revenue. Main thing to understand here is that they have cut their full year guidance and they are expecting decrease to their top line as opposed to a very marginal increase. The main thing that we want to point out from this diagram, now it is from 2022, but as you can see, even over the last few years, Nike is essentially the leading in the sneaker world, 29.1 billion. When you do look at their closest competitor, Adidas, 13.1 billion. The questions you have to ask yourself, Is this an overreaction? Do you believe that over the longer term their market share will continue to get eaten up? It isn't just these companies that we see here. There are the competitors as well. As we can see here, you have Lululemon, you also have Kappa, Reebok, New Balance, Under Armour. I'm sure there are many others that also haven't been included in here. So again, lots of questions to understand. Ultimately though, the company is down 17%. It continues to fall down as well. 29% down year to date. Over the last 10 years though, if you are a shareholder, you would be up 98.5%. We can see all-time highs $177. And as we can see, it is now at its 52-week low. We do have one buy rating from Wall Street, a double hold from the other two analysts. We'll talk about the forward yield. It hasn't updated here. It is now nearly at 2%. And the forward P, again, while seeking alpha, haven't updated this, has come down. So again, we will need to compare this not just to essentially the S&P, which is at 22.5, but also to the sector P for more relevancy. So let's get in straight in then with the numbers on the top line. What we always want to see, 3 to 7% growth at a minimum, and we can see 31 billion reported in 2015. Latest annual accounts 51 billion. So that is some very strong growth over the last 10 years. As we can see, consistent increases over the longer term, always a great sign. You don't want to see companies that increase their top line very rapidly and then it comes negative. You want a bit of consistency in the portfolio. But one thing that we need to point out from their guidance, 2025, they are anticipating a decrease to their top line. One of the reasons we have covered why they have suffered in terms of their share price drop today. The next thing we have is their bottom line net income, 3.3 billion in 2015. Nice to note, very similar to the top line. It has also increased nearly double to 5.7 billion. Although we do note, whilst the top line increase was consistent, their bottom line net income a little bit more inconsistency. And as always, all of these different things we will incorporate into what we call our investor margin of safety later on in the episode when we look at the valuation. We then move on to the health of the company. Now, total cash versus total debt, 6 billion of cash short-term investments 2015. Pretty much doubled that now in their latest quarterly report, just under 12 billion. And over the longer term, their cash position has been increasing. Always a nice sign to see. But again, we do need to compare it to their total debt numerically and directionally. Otherwise, in isolation, that number doesn't really tell us anything. What we can see, their total debt, 1.3 billion. But it has increased significantly to just under 12 billion in that latest quarterly report. Again, very similar to their cash. Over the longer term, it has increased. Some years a lot larger than others. Nice to note though, from 2020, it has started to come down. So it does look like as part of their strategy or capital allocation, they are looking to lower down that debt. So it isn't also too far off their cash balance. So we would say the balance sheet does look pretty decent, although we will come to look at that net debt to EBITDA metric very soon. So we look at the earnings per share for two reasons. One, to see their historical accuracy, and two, to see what they are forecasting out into the future. Now, what we do note, over the last 4 quarters, they have got a 75% track record of beating analyst targets, but what we actually find in today, they haven't updated their quarter 4 yet, which they did just beat. So when you do look back at the last 4, including today, they have a 100% track record of beating the earnings per share. Now, whether or not that gives you confidence moving forwards, that is something just to consider. But we can see over the next 3 quarters that we have the information for, Nike is anticipating negative growth to their earnings per share. In fact, negative to quarter 1 2025. If we do look out to May 25 with their EPS estimate, which as we can see lower than 2024, their forward PE will sit around the 25.85 level. Again, just to consider within your own investment analysis. Now we're going to look at the valuation grade of Nike, which we have here as an F. We will quickly run through the PE versus the essential sector medium. Thing we want to highlight here, as they haven't updated the numbers yet, when we do look at the updated forward PE, right now it does sit around 20.9. We'll come back to this information shortly, but let's just have that in mind. 20.9, then effectively what we are saying, it is still higher than the sector medium, which does sit at 15.43, so it is trading at a premium. Question is whether or not you do believe it is worth that premium based on the other metrics we are about to go through. So what we can clearly see then on any other metric as well, valuation wise, they are trading at a premium. We then move on to the growth grade where they do get a C. Now year on year revenue growth, we can see marginal increase at 2%, not too far off the sector median, which is pretty much there or thereabouts. Now forward looking, as we've just seen, again, this hasn't been updated. It is anticipated to be negative growth as we can see the sector median around 3.63%. And when we do look at the earnings per share estimated growth over the longer term, 9.7%, with essentially the sector median at 11.08, so marginally better. So it does raise questions whether or not the PE of Nike is too high, regardless of where it sits right now, as it is still higher than the sector median. Is it warranted based on the growth? The answer clearly is no. When we take a look at profitability, well, they get an A+, so we can see that their gross margins are better than the sector median. The same can be said for their bottom line, 10.14 versus 4.85, and we can also see their cash from operations significantly better at 7.1 billion versus 280 million. So still questions to be asked there whether or not that valuation is justified. But to wrap up this part of the analysis, one buy rating from Wall Street, a double hold, an F on valuation, a C on growth with an A+ on profitability. Now in terms of how they've performed against others in this sector, so we do have Deckers, we have On Holding, Skechers, Crocs, Steve Madden. In terms of the total return, so including dividends reinvested, over the last year, we see them as the worst performing, negative 31%, and the trend that we can spot here is that this is in isolation. The others have performed very, very well. In fact, every single one of them, maybe bar ON, which is in line with the S&P, have outperformed the S&P over the last 12 months. Nike, as we can clearly see, has not. Over the last 5 years, worst performing, negative 2.5%. And when we look over the last 10 years, nice to note it is positive even after today's massive crash, up 121%. Still though in the lower end of the competitors in the market. We then move on to a very important question. Do you believe it will outperform the S&P? Now you need to ask yourself that every single time before you invest in a company and have a certain degree of confidence. Otherwise, look at low-cost ETFs as an alternative. So historically, how have they performed? Well, S&P, no surprises over the last year, significantly outperformed NKE. Over the last 5 years, again, significantly outperformed. Over the last 10 years, we do note a very marginal outperformance, but interestingly, we can see over a long period, Nike did actually outperform the S&P other than this drop right now that we see, which does raise the question, if you are looking for security as opposed to individual stock, where after a quarterly earnings report, they can pretty much tank, then again, S&P does give you that security over the longer term. Now, just to let you know, we have released our latest free weekly article where we run through 10 undervalued stocks with phenomenal balance sheets. If you want access to this or any others, all completely free, do click on that pinned comment below. You can start to read and sign up straight away. We then take a look at insider ownership, pretty low, 0.5%. We see one insider buy over the last 12 months for 1.26 million, but we see 4 insider sales over the same period with a massive $43 million. And what we note in Q2, so the more recent period, 20 million worth of sales. When we take a look to see who these insiders were, we can see on the 14th of May, Mark Parker, the chairman, sold a massive 168,000 shares, $93, so a lot higher than it sits at now, for 15.7 million. Whether or not you want to include that is completely up to you. Within the same month, we can see the VP and the EVP sell, so pretty much around 20 million worth of sales just over the last 2 months. As always, we would say it's not necessarily bearish. They could sell for personal or financial reasons. Information is there. You can come up with your own conclusion. We then move on to institutional ownership. Now 64%. We see 10 billion worth of sales over the last year, but we see a lot more buying over the same time period, although we do have to point out the majority of that buying did come in Q2. When we do look at the more recent quarter though, we do see more buying, 2.4 billion versus 1.63. The same to be said for Q4, so the last 2 quarters as well as the last 12 months. Now, regardless of whether institutions buy, insiders buy, whether they sell, always understand that you need to perform your own due diligence before executing on any company. Now, let's get into the dividend safety 99 score, as we can see now with the updated live yield of 1.9%. And let's run into this information. Market cap 142 billion as well, a mega cap company. It was reaffirmed a few months ago that essentially their very safe score indicates a dividend cut is unlikely. And for those that like to see that recessionary data, they increased the dividend during the 07-09 Great Recession. They had above average growth, -7 with the S&P being -12, and they also significantly outperformed the S&P, -36 versus -55. This has also been considered a dividend growth company, a nice 9% increase last year, double digit both over the last 5 and 20 years, so that is very positive to note. And they have been increasing those dividends for the last 21 whilst paying a dividend for the last 39 without a reduction, so they are 4 years away from becoming a dividend aristocrat. Now, when looking at dividend yield theory, it does say the company is undervalued when the current yield sits above the 5-year average, so we have a massive undervaluation signal, 1.92 versus 1.04, and again, forward P 20.6 versus the 5-year average of 31.9. We do, however, note it is above the consumer discretionary of 13.8, but as always, we're not looking at any of these models in isolation. We will conclude towards the end. So in terms of free cash flow, which we do draw your attention to as the earnings is susceptible to manipulation by management through accounting, below 60%, that is what we see every single year bar 2020. Absolutely phenomenal. 42% over the last 2 years. 47 anticipated over the next 12 months, so we can already see how they are able to offer those nice increases to the dividend. No worries with that, and again, we can understand why that dividend safety score sits at very safe. Free cash flow, always look for consistent increases over the longer term with companies you want to consider for the portfolio. Pretty much what you see with Nike, bar some years where it is a little bit inconsistent, like the COVID 2020. Otherwise, it is moving in the right direction over the next 12 months, so minimal increase expected from 2023. In terms of sales growth, as we mentioned, 3 to 7% year on year, which is again what we get bar that justifiable COVID year. The important thing to understand, even though we get a nice 10% increase in 2023, they are anticipating for the next financial year to have negative growth. We then move on to numericals. Again, we did see this, so just another format to look at. In terms of these shares outstanding, nice to note they do return that excess cash through those share buybacks. Maybe not as much as you want to see, maybe not as consistently as you want to see, but having this on top of those nice dividend increases is always a positive sign for investors. We then move on to the ROIC, a very important metric in my opinion. 10% or more give us faith that management are able to effectively allocate their capital. We get to see that, yes, it has decreased, but even over the last 2 years in the low 20s, a very strong sign which all potential investors will look out for. In terms of the operating margin, above 12%, pretty much straddling around that as long as they maintain and don't drop any further. And on the free cash flow margin, consistently above that 5%, last 2 years at 10%, trailing 12 months at 12%, a very good sign. In terms of the final metric, the net debt to EBITDA, which is the earnings before the interest, tax, depreciation, amortization, the below shows us the number of years it would take the company to pay off all of that debt net of cash on hand. Below 3 is what we do want to see here. 0.19 in 2023, 0.18 expected over the next 12 months. This has a phenomenal balance sheet. Their dividend looks to be very safe. As we saw, that free cash flow payout is very low. So no worries whatsoever. Always great when you are looking at companies that do have a very, very strong balance sheet. So let's jump into the valuation, probably one of the most important things of today. Let's get to our intrinsic value. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model, multiples valuation, average P, multiplied by that essentially of Nike, and we get to see here intrinsic value of $101. We have our first undervaluation signal, and as always, we never look at any one of these models in isolation. The next model, the dividend discount model, now we have some nice growth over the period. Average growth around 11%. We've gone very, very conservative at 6.5%. And as we can see here, another strong undervaluation signal. We then move on to the DCF model. Now we have the free cash flow year on year, average growth at 40%. Now we wanted to be very, very conservative. We've gone for 9%, which is not just below the average growth, also lower than the increase over the last year and lower than management target. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see again another undervaluation signal. So for this company, we get a triple undervaluation signal. Do bear in mind, you can grab a copy of this model by clicking on the pinned comment below, running in your own numbers for your own stock. $101 as our intrinsic value, the current price at $77. And what we always do is we start off with a 10% margin of safety. Now we execute on this if it does meet our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that, then it is a buy up to $91. Then we keep going till it's near the current trading price. At $86, we can see you would get a 15% MOS. At 20%, around $81. and at 25%, not too far off. We're talking around a $1 off the current trading price. Now, for me, you need to answer two questions. Essentially, the first one is, do you believe over the longer term that this will outperform the S&P? If the answer is yes, the second question you need to ask is, do you believe that the competition will continue to eat up the market share of this company? If you believe the answer for that is yes, then it may be one that either you need a larger margin of safety or maybe not one to add to the portfolio. For me, if you are looking at a 25% margin of safety, that is a very good chance that this is a company that should be a buy if you do believe in it over the longer term. It isn't always that you get a high quality company at a 25% MOS level, but again, you need to answer all those questions, see whether or not you do believe it is high quality and that you do believe over the foreseeable future it will outperform the S&P. In terms of Wall Street and their forecast, well, over the next 12 months, they have updated their price target, so they have lowered it to $100. Even after that, they see 30% upside, and they pretty much see it in line with our intrinsic value, which is always good to see when they aren't too far off. But as always, let us know your thoughts in the comments below. Is this one you are looking to buy? Is it one you're looking to sell? Or maybe it's one you're looking to lower down your cost average? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.